Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. So let's talk about the different types of commercial property that you can invest in. And as commercial people, we're very simple. We like to break things down into really simple sectors. But obviously, the whole point of that is that simplicity is needed because it's such a complex sector. Now, don't worry about that. That doesn't need to put you off commercial investing. You just need to understand the different sectors and how they all work. So let's get stuck into that, and let me tell you a little bit about all the different types of commercial property that you could look at, and then we can kind of break things down into looking at things in quite a simple manner, because, as I say, simplicity is what we're aiming for here. So commercial property is any type of commercial space that's occupied by a business. So business tenants occupy commercial real estate. So obviously, if you think about all the different types of businesses in the UK right now, then you can see that there's loads of different types of commercial property. And of course, if we talk about retail or industrial or offices, what that belies is the complexity in that sector. And of course, this is one of the reasons why we can niche so well in commercial real estate, is because we kind of need to niche, number one, because there's so many different types of property. So if we were trying to look at everything or trying to kind of embrace that complexity, then we're going to get a bit overwhelmed with our investing. But also, it really is important to make sure that we break things down and we can really target some of these niches within sectors where we can make higher than average returns. And that's the whole point of niching, is so that you can be really laser focused with your investing. But it's also that you can target those sectors where tenant demand exceeds supply and where you can make higher than average returns, because that's the name of the game with investing, right? That's what we're looking for. So let's talk about the different types of sectors we can look at. So there's three main sectors. So I've been involved in commercial real estate for 30 years, over 30 years now. And really, for many years, we broke it down into three main sectors. But now there's more that's included. We used to basically say retail, office, industrial, and then alt sectors, alt meaning alternative sectors. And the thing is that for many reasons, these alt sectors, these alternative sectors, are now becoming really institutional grade investments in their own right. So we've got to think back about the history of commercial. When I first started in commercial, everything was on 20, 25-year leases. I remember being horrified that we could get a 20-year lease, not a 25-year lease. And there was 5-yearly upward-only rent reviews. And basically, tenants had to do what they were told. And, we fast forward 30 years and the market is very, very different. So when all lease types were the same right across every sector, it kind of didn't matter what you invested in. You were going to make money. That was the basic fact. You were going to get a tenant on a long lease and you were going to make money. As the supply and demand balance has become more important, the balance of power in some sectors has moved more in favour of tenants than landlords, then a choice of sector is really, really important in terms of, and the choice for investment is important, because some types of investments you get long leases, some types of investments you get short leases. Some types of investments, tenants will be able to ask for lower rents, more rent-free period, break clauses, and in others they won't. So, and COVID really brought it home, where a lot of funds were investing in retail, office, industrial, and they had funds for each of those, pension funds. And what COVID, I think, brought home was that too many eggs were in the same basket. So, these retail funds, they plummeted in value. And so that's one of the reasons why logistics space and industrial went up in value, because the market felt that was quite future-proofed in terms of where the trends were going, the rise in online shopping, the logistics trends, and so therefore they felt that everybody started to pile into industrial because they felt like it was safer than retail. It would always add value. And there was kind of this almost artificial spike in industrial because everyone kind of piled in there. And then as a result of COVID, but it was happening before, there's a lot more casting the net wider to look at these alternative sectors. So not just retail, office, industrial, but looking at these alternative sectors. And and I'll talk about it in a minute, kind of what's within this alt sectors, and how they've increased as an institutional asset class. But for example, if you take healthcare, if you have an NHS tenant on a 20-year lease, that's about as good a tenant you're going to have. It's about as good a lease you're going to have. RPI linked rent reviews or upward only rent reviews, and that's better than a lot of kind of office, industrial, or retail tenancies you could get right now. So what a lot of sophisticated investors have done is they've cast their net wider. They're looking at renewables, they're looking at build to rent, they're looking at healthcare, they're looking at leisure, and so therefore I think that it definitely is a more complex market than it used to be, but that's where the fun is. Like, believe me, that's where the fun is. That's where the choice of niche becomes really key. And that's where you can really clean up in terms of your investing strategy. So this is a massive opportunity to really focus and really understand a location, a niche, a sector really, really well. Okay, so let's rewind and let me tell you about the different sectors. So first of all, I'm going to just tell you the headlines and then we'll kind of dive into each sector. So first of all, we've got retail, then we've got office, we've got industrial. We've talked about that, the three main sectors. Then the alt sectors now are leisure, we've got health, and then we've got build to rent. That's now an institutional asset class, grade asset class. We've got we've got healthcare. I think I might have said that. We've got purpose-built student accommodation. We've got renewables, and I could go on. Basically, business tenants, anything on a commercial lease, they're seen as commercial income. So let's go through each of those in turn and talk about where the market is. So retail. So you would literally have had to be hiding under a rock not to know, obviously, what happened to retail during COVID. We had some really high profile failures. Unfortunately, we had some really big brands like Arcadia, Debenhams go under. And, we've seen a steady trickle since then, Wilco's and kind of various others. So why is that happening? Well, obviously, we've got, number one, a change in consumer trends. We've got retailers having too much space tied into penal lease terms. We've got, the changing nature of shopping, the rise in online. And we've got a lot of the fact that a lot of retail, frankly, is boring. I don't think a lot of retailers have learned their lesson. You still go into a clothes shop and there's still rows and rows of clothes without having any interactive, experiential kind of stuff. So I do think a lot of retailers are missing a trick. And we've seen a lot of the rise of kind of niche retailing, kind of looking for these alternative high streets where you get these lovely niche independent retailers. And, the customer is really attracted to that just because, it's something a bit different. And, we developed identikit high streets. And also, a lot of big town and city centres had a lot of shopping centres developed. In some places there's 2 or 3 shopping centres. And of course, now there's just too much space because retailers are basically looking at their portfolios and saying they want to reduce the amount of space. So then the government brought in permitted development rights, to conversion to resi, conversion within Class E to lots of different uses. And that's the subject of a whole different episode of this podcast. But retail, during COVID, basically, when I was in the corporate world I left into 2015. When I was in the corporate world, we knew that retail was probably overvalued, if we were being completely honest. But a lot of valuers were really reluctant to really annihilate values, because that's not what they like doing. And so there was a bit like a death by a thousand cuts. You get gradual decrease in values without seeing this dramatic decrease. And of course, COVID gave a rebasing effect. So basically, retail values were rebased, rents reduced, and in a lot of locations where there's a lot of vacant space, the market turned in favour of tenants. And so how can you capitalize on this? Well, I think the first thing to say is that, I still see lots of headlines about retail is dead, the death of the high street, etc. But I think the first thing to say is there's lots of different types of retail. So again, we mustn't generalize in commercial. So if you think about retail, obviously you have your high street unit shops, you have your larger, we call them MSUs, or medium-sized shop units. Then you have your department stores, your anchor tenants, your very few of them left, but your John Lewis's, etc. And then you've got your out of town retail. So you've got big shed retail, whether that's bulky goods or whether that's kind of open A1 kind of clothing type retailers out of town. And then you've obviously got your takeaways, you've got restaurants, I'm kind of lumping all that. It's really leisure, that kind of thing, but they all tend to cluster together. And then obviously every high street is different. So you've got some towns or cities that maybe have 3 shopping centres where there's just too much space, and it's really difficult to fill space, and there's lots of empty shops. And then you've got some high streets where literally there isn't an empty shop because there's lots of demand. People are shopping local. Maybe the socioeconomics are good. Maybe there's other reasons why people are visiting, like tourist trade. And so you can see why it's dangerous to generalize. So when I see headlines like all retail is dead, then that's a good thing, because actually that means that, if the masses are running away from a sector, then I love a bit of contrarian investing. So I invest in locations where I know that the supply and demand is very much in my favor as a landlord. I know that whenever there's a void in these particular towns, then I know that they will be filled very quickly. I know I can get longer leases. And really, that's the name of the game. You want to sniff out these locations where there's still good demand. And sometimes there's in these locations, the size and configuration of the shop units just isn't suitable for the demand in the market. And so is there something you can do to the units to basically subdivide space or reconfigure it or whatever else, where you can cater for the demand? And therefore, perhaps the unit you buy initially, there is little demand for, but if you did something, if you reconfigured it, maybe converted a bit to residential, maybe brought other uses in, then is there something that you could do that kind of creates that demand and you can cater for the demand of the market? Then, of course, if you're catering for the demand, then you might be able to get longer lease lengths, better tenants, better lease terms, etc. So very, very, very dangerous to generalize in retail. As a general rule, out of town retail is done pretty well. Starting, it's still quite an institutional grade asset class. Funds and property companies still really like it. Obviously, it's expensive. In London, a lot of retail parks, out of town retail, up until recently, were being bought to be converted into logistics, into residential. So definitely look at that as an angle as well, like some really strategic key locations where that was taking place. Definitely don't write off retail. I would recommend you get in the car, go around your investing locations and just look at the number of empty shops, look at the footfall, look at the number of people shopping, look at the availability of parking. Talk to the shop owners, how are you trading, how's business? And you will quite quickly get a flavour of how things are going in that particular location. And once you get your eye into this stuff, you will definitely start to work out those locations where demand is greater than supply and where perhaps there's opportunities for investment. So that's retail. Offices. Now, offices, again, very much affected by COVID, changing working patterns and flexible working. Now, we're starting to see a bit of a movement back into the office, but I think this is here to stay now, in terms of, some big corporates are kind of getting their businesses back into the office full time. More likely is that maybe there's 3-day weeks in the office, this kind of hybrid model now. So there's a big race to prime in offices. So grade A offices with all the renewable incentives in there, like, heat pumps and great specification. They are going really well. They're an institutional grade asset class, so at the top end of the market, they're going well. Developers are running scared from office development, and so the development pipeline is continuing, but there is very little new coming into the planning system. Lots of repurposing of secondary offices, and that's the thing. I think that these big offices, these 80s, 90s, 2000s offices that are now kind of between 15 and 30 years old, maybe 10, 30 years old, are that there isn't an anchor tenant for them. There isn't one tenant. You can't even let them floor by floor. So therefore, there's repurposing opportunities. So that can be residential through permitted development or through planning. So there's challenges with that in some big office footprints, because you've got daylight sunlight restrictions in the middle. For smaller office space, obviously that can work quite well. But actually, don't write off just reconfiguring as commercial. Dividing into small office space, this kind of CMO, this commercial in multiple occupation model, genuinely, it's doing well in so many locations, so many towns and cities. Obviously, you need to check supply and demand. If there's loads of this stuff, then it probably won't go away. It won't get away in terms of letting. But if there's a market for that, then it can work really well by subdividing secondary office space. And here's the thing, is that that kind of kit, you're seeing a lot of it in auction at the moment. It's going for really competitive prices, very low prices, and prices are still falling for secondary offices. So business parks for larger secondary offices and town centres. So, but the really, really important thing is to check out demand beforehand. Make sure that you understand the sweet spot in terms of the size of office suites, and you cater for that demand. Now, it's not just office tenants and businesses that will take offices now. It's everything from storage to beauty therapists to chiropractors, physios, acupuncturists, whatever else. Like there's actually a high demand from those kind of uses, kind of health suites, etc. So obviously not everywhere. It's always dangerous to generalize, but there definitely is demand in that market. So and as I say, like if you were to ask me which sector is still falling, where the best buying prices are at the moment, then it's definitely the secondary office sector, without a shadow of a doubt. So it's definitely worth looking at for sure.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So now let's look at industrial. So industrial has probably been one of the winners, in inverted commas, of COVID, in terms of, as I said earlier, a lot of investors starting to pile in there because they felt that it was kind of future-proofed for future use, especially at the top end of the market, like logistics. Obviously, industrial is a massive sector. You've got everything from the kind of flex units, the small units on industrial parks, right through to data warehouses, cold storage, logistics. And obviously that territory is a territory of, large investors. And that end, life sciences, that's doing incredibly well. That's something the government's really supporting. These gigafactories, they're becoming part of national infrastructure, logistics space, etc. And there's growing demand for that. And after COVID, there was lots of kind of disinvestment. So people moving out of retail and offices and into industrial. So that we had this kind of hope value spike in the industrial market, which is still kind of lingering, although obviously prices have fallen a lot. And, don't be surprised if you're investing in industrial, to in some locations, you look at the pricing and not be able to compute it, because I think some agents have still got that view of industrial. And of course, in some locations, demand is really high, and so therefore it can be a great investment. There's a lot of locations where there might be demand for smaller units, but not larger units. So you really need to understand that supply and demand equation in the market, speak to commercial agents, do your own research, look at units to let and rents and lease terms, and, kind of just get a really good flavour of the market. That's the benefit of niching, obviously, is that you can really get under the skin of the market and you can really start to understand it. And you'll get this competitive advantage because you're the one that understands it better than others. So a great strategy at the moment is to buy larger industrial space and subdivide it into smaller units. Doesn't work in every location, but it can work really, really well in a lot of locations. And commercial finance really likes that as a strategy as well. And then you've got, so we've talked about retail, offices, industrial. Then we've got these alt sectors, which are now kind of very much institutional grade assets in their own right. So you've got healthcare, and obviously you've got everything from kind of later living, which is kind of retirement schemes, to care homes, to health suites, doctors' surgeries, dentists, hospitals. Again, very dangerous to generalize, but you can get fantastic financing on them if you get longer leases, value add opportunities, great covenants potentially as well. So healthcare is definitely not to be sniffed at. And it's one of the few sectors where you can get longer leases now, which, I'm talking like 10 years, 10, 15, 20 years, to great covenants as well. Not the easiest deals to get done because the nature of the beast, especially if you're dealing with the NHS, but once, it's worth it once you get there. Then you've got leisure. So leisure is leisure, retail, hospitality. They're really being affected by minimum wage rises. The cost of labour is affecting them because it's cheaper labour. I expect to see lots of automation in those kind of sectors. But yeah, leisure, kind of cinemas. I'm going to lump hospitality in there as well, although it technically is separate. But restaurants, bars, wine bars, cinemas, bowling. And then you've got this competitive socializing, which is things like golf bars, and you've got cricket bars and darts bars and table tennis bars. Really great use, by the way, for basements, those kind of uses. So leisure, and of course, we don't just want to sit around and order things online. We might shop online, but actually we are social creatures at heart. And so this getting together is at the heart of it. And actually, if you were to say to people, if you've only got £10 in your pocket, what are you going to spend it on? You're probably not going to go for the kind of discretionary spend, which is, buying a new top or a new something for the house. You're probably more likely to buy it spend it first of all on food, which obviously is a very niche sector in retail in its own right. But then you've also got socializing, eating out, seeing friends. That often is a priority, depending on stage of life, obviously. So and what we're finding is a lot of cinemas are being affected at the moment by the writers' strike. That's really affected the quality of the films coming out, and obviously the streaming services are, things aren't necessarily coming out into the cinemas first. We've seen Cineworld kind of renegotiate a lot of their leases recently. So, that is being affected, and that's affecting shopping centres because quite a lot of those are anchor tenants. So they're rationalising their portfolios. So that is a bit of a problem for some kind of leisure schemes and shopping centres. And then you've got build to rent. I'm not going to go into that loads of detail, but obviously you can get long leases to providers, or you can manage it yourself. And I probably would include kind of some element of health in that sometimes. Sometimes it's build to rent for supported living, for example. And you can get commercial leases on those. But, I think if it's above a certain size, it's commercial. If it's still a house, if it looks and smells like a house, it's a house. So, don't get fooled into thinking that is necessarily commercial. And then you've got kind of sectors like renewables. Increasingly you can get kind of long leases on those. And then you've got all these little subsectors in everything I've just talked about. You've got like roadside retail. That's really doing well. Roadside retail is like petrol stations, and where they might have an M&S or a Waitrose in them, or a restaurant on the side of the road, or kind of that is actually doing McDonald's, fast food, Starbucks, drive-through. That's actually a really growth sector. You get longer leases. Quite often they're kind of purpose-built developments a lot of the time, rather than repurposing. But a lot of the funds like buying those. As I said, the food sector is doing really, really well. So because you get long leases with RPI linked, CPI, RPI linked increases, rent reviews. So you can see that commercial property is a really wide-ranging sector, but the devil is absolutely in the detail. And if you look at the commercial use classes, you can see all the different types of uses. If you look at the sui generis class alone, you can see all these strange and crazy uses that I haven't even talked about today, like waste transfer sites and big leisure halls or whatever. Like they're really specialist niches that in some locations you can make some good money out of. So I think the key is not to be overwhelmed by the size of the commercial sector. And the reason we break down into these different sectors is to try and create some simplicity around it. And so what we want to do is we want to assess the supply and demand in our local market. So a really great question, if you're doing a viewing or you're speaking to a commercial agent, is, what's letting really well at the moment? What's letting really well at the moment? Go and walk up and down your local high street, look at whether the availability of space to rent. Don't just look at things for sale, and just see whether things are letting really quickly. I looked at a particular location. I was looking for a new investing location, and I looked at everything to let, and I could see that everything that was to let was letting really quickly. And that's a really great sign for me that, that there's some really good demand in the market for that particular location. Now, obviously, again, the next level of due diligence for me now is to look at what lease lengths can I get? What rents can I get? Because it's all right letting something, but if you're going to get peanuts for it, then obviously you don't want to do the deal. So what kind of rent can I get? What kind of lease length can I get? What kind of tenants can I get? And that's obviously really, really important as well. So look at the generality, think about those trends, but then really get into the specifics. And this is where niching comes in. And I'll do another podcast all about niching, because actually niching is really the key in commercial real estate to making money and to really understanding a sector in really, really, granular detail and becoming the expert in that, so that you can basically make higher than average returns. So I will definitely do that in a later episode. But for now, to take action, definitely start thinking about what I've said today. I would definitely kind of go on to some of the commercial portals, have a look at property for sale, property for rent, and then definitely get in the car. I think in this digital age, we tend to sit at our desks and do our research, but there's nothing like going out, looking, touching, feeling commercial property to really understand the dynamics in the market. Obviously, it's easier to do in some sectors than others. Like it's easier to look at high streets than it is to look at offices or industrial, of course. But that's through kind of building relationships in the local area. So definitely get out there in the car, and I'll see you next time.